Holistiplan presents Tax Time with Jeff Levine. Let's talk taxes. Hi, I'm Roger Pine from Holistiplan. I'm here with Jeff Levine. He is the Chief Planning Officer at Buckingham Strategic Wealth, also a member of our team here at Holistiplan as our tax planning strategist. Jeff, it's great to see you. How you doing?
Good, man. Good. I feel like we're like Mark Zuckerberg and his attorney on here between the way we're dressed. I like it. We're a good pair.
To be fair, I spent 20 years of my career dressed like you are now,
Mhm.
and I went into startup life so I could dress like this. But you're right, I'm feeling underdressed at the moment.
I don't know what I would do if I couldn't wear my vest every day. I mean, that's like, well, I'd have to like have a t-shirt that just was like I just have wear tank tops, I guess.
Yeah, I can give you some pointers on dressing down. You get used to it,
All
Jeff.
right.
Well, we're going to talk today about really, I think our focus over the last few of these videos has been things that have to get done by the end of the year, December 31st. There's a lot of things you can procrastinate on life, but some of the tax things have to happen by December 31. Although I guess today we'll talk about a few things that may slip, but um, we're in that season where you got to get some things done from a tax planning perspective. And the thing we're going to talk about today is withholding, estimated taxes, making sure you're paid up to the extent that the government expects you to be paid up during the year. So, Jeff, I would be interested in hearing from you first. What are the rules? What are the gotchas? Because we've all had that situation where the client has, or even we personally have had that underpayment penalty or that scary looking form that kind of surprises us sometimes. So, what do we need to be mindful of with respect to paying our tax bill in advance during the year?
Yeah, so I think the highest level, it's worth noting that we're a pay-as-you-go system, right? We're a pay-go system when it comes to income taxes. So you're supposed to pay income tax as you earn money. Now, clearly, if we did this on a daily basis, it would be largely unmanageable, right? Like, hey, you worked 12 hours today, so therefore send in X percent of the pay today, but you work 10 hours tomorrow and 6 the next day. Like, that would be too cumbersome, even for our tax system. So we generally structure this to be in quarterly bites, if you will. So there are 4 quarters to the year. So generally you're making, you structure your payments into 4 different quarters. Now, that said, a lot of people don't ever worry about the pay go system or quarterlies, et cetera, because they're kind of automatically paying money in as they go along because they're working and they have a W-2, right? And they are withholding dollars from their paycheck. And so by withholding from their paycheck a little bit each time, you're effectively doing that, right? Let's say you get paid biweekly. Well, every 2 weeks, you're sending a little bit of your little bit of your earnings to the IRS in the form of what are really estimated taxes, but we don't call them that, right? We call them withholdings when they come from your paycheck. But for those who have either all of their income or a substantial portion of their income that come from sources that you don't have withholdings, so think like self-employment income would be very high on that list. But also, while interest, technically you can, in many cases, call up your custodian and say, please withhold X from my interest income. Generally doesn't happen. So investment income is another source of income from which we generally need to do estimated taxes. And if you need estimates, what you are required to do in general is to choose between the safe harbor that looks at last year's taxes or one that looks at this year's taxes. If you want to use this year's taxes, then you should be paying 90% of your current tax throughout the year, generally in equal installments, right? So if you owed $10,000 of taxes for this year in 2021, then you should be spending or paying 9,000 in throughout the year in equal installments from Q1 to Q4. The problem with that, and the reason why a lot of people don't use that method, and the reason why CPAs generally don't prescribe that as the best way to do things, is we don't really know what this year's tax liability is for a lot of folks until we get later in the year, right? I mean, business income could change, investment income could change. And if you're W-2, you might say, well, it's pretty static, but then you're paying in your income taxes via withholdings. So you don't really worry about this. So for those other unwithheld sources of income, they tend to be more variable. And so using this year's tax liability is not a great way to go about it for that purpose. So the other way you can go about it is using last year's tax liability. So you can pay in, for most taxpayers, 100% of last year's tax liability, and that's a safe harbor. Now, for some higher earners, like many of our clients here as financial advisors, it's actually 110%. So let's say we had that, a tax liability last year of $40,000. You might have to pay $11,000 in per quarter this year, 110% of last year's tax liability, to have that safe harbor. But that means no matter what your tax liability is this year, there won't be a penalty. Now, just to be very clear, I'm not saying that you won't have a tax liability in April. You just won't have a penalty on that amount. So a good example of this would be last year, your client had a tax liability, again, of $40,000. They paid $11,000 in each quarter this year, but on March 1st of 2021, they won $100 million in the lottery. Now, they don't get to only have to pay $44,000 on that $100 million lottery winning, but they wouldn't have to make the final payment of income taxes on that amount until April 15th of 2022, and that would still be timely, and there would be no estimated tax penalty. So at a high level, that's the way most estimates work. Now, it's worth noting that one other point here, that there is an alternative method to what I just described. I know it's like an alternative to an alternative, but that's our tax system, right? There's something called the annualized method of doing estimates. Now, this is used only for those with extreme income, because you're basically doing a mini tax return 4 times to figure out how to pay that amount. So the cost of labor to prepare that and do that work is generally cost prohibitive unless you have significantly variable income, and unless a lot of that tends to be earned in the later parts of the year, right? If you're someone who typically gets a monster bonus in Q4, maybe you don't have to pay a lot Qs 1 through 3, but you do a big amount in Q4. If it's a $800,000 bonus every year, maybe it's worth doing the annualized method. But for most folks, it's not. And so we rely on these safe harbors in general based on last year.
Yeah, and just to double click on that, that's part of your tax return review process. And in fact, Holistic Plan's tax report will automatically determine, hey, you're in that higher bracket, so to speak, for the safe harbor versus not. It'll calculate that for you. That's really something you could be doing in May when you're doing a tax return review for a client. And you mentioned one other thing about, and we may get to this, or we will get to this, is there's the difference between estimated tax, which is you mail in a check or you use the online. I've started using the online thing lately, but you mail in a check, or there's withholding. And withholding is understood to have happened throughout the entire year. Even if you did, say, that $800,000 bonus at the end of the year, that withholding is treated as if it happened throughout the year.
That's exactly right.
My understanding is the same is true for withholding on a retirement distribution. So I'll give an extreme example. This was something that was common in my firm. We worked with a lot of college professors who had massive retirement 403B balances. Okay, we're talking like $2 million all in retirement. And so they could take their RMD on December 31st, withhold 100% of it if they wanted to pay their taxes that way. And my understanding was and is that the IRS treats that as if that withholding happened throughout the year. So you don't have that penalty situation where you're mismatching, because you can't cheat and put all your estimated taxes on January 15th. You're supposed to spread it out throughout the year.
Okay.
My understanding is withholding is understood to be throughout the year, even if it happens December 31. Is that correct?
That is, by default,
Okay.
It is treated as though it's paid in ratably throughout the year. So in fact, I know we were going to talk about, fixes, like what if your client is under withheld as you go through this process and you check, essentially that's what we're looking to do here, right? Is to do a quick checkup at this point and say, where should we be? Where are we? If we're good, great, like thumbs up, way to go client, nice job. If we're not, what are our options for fixing it? And, if you don't have a source of withholding, writing a check sooner rather than later certainly is the best way, the best available solution. It's not always the perfect outcome, but it's the best available option. But for someone who does have a source of withholding, whether that be a job, right? You can hey, HR, please withhold 100% of my last 3 paychecks, and I won't have as much withheld earlier in the year. You could kind of play some cash flow games for folks. Or in your example, the individual with the retirement account, withholdings are withholdings are withholdings are withholdings. So whether that's coming from a paycheck or a retirement account, yeah, that's a fantastic option. In fact, I use this all the time. So here's my neat little trick, right? So I'm gonna you mentioned, you used the term double click on what you said. It must be some coder speak for like yes and you. So I'm gonna double click you, I guess, and I'm gonna double click on that and say, one of my favorite little tricks here for those who haven't done a rollover within the past year is to use their retirement account as the fix year, or as a way to, especially when interest rates were higher, to kind of game the estimated tax system and get a year extra of interest, right? Imagine you could get $10,000 of interest by not paying your taxes evenly throughout the year, but you don't want to have an estimated tax penalty because that probably more than offsets whatever interest you could get in the bank, right? Giving away $10,000 is that is not good planning. But how do you fix it? Well, imagine we had a client with an IRA or something like that, where we could take a distribution at the end of the year of $150,000 and pay that tax liability. So a pretty good income. That's probably someone with about ballpark math off the top of my head, probably someone about $650,000, $700,000 would create that $150,000 tax liability. So good income, but not unseen for financial advisors. Let's say we did that and we had a $150,000 distribution, but your client is only 40 years old. You might say, well, that's crazy because now we've got the income tax, we've got a 10% penalty, you're taking it out of compound. Well, you should, even if you didn't pay the estimates, you should have been banking it, right? Put it in your bank account, literally banking it, right? In some sort of separate account, or just earmarked in your own system for this will be used to pay the income tax liability come December 31st. I'm going to withhold an amount, or maybe not that close, maybe December 20th, so that we're not pushing it against the 11th hour here. But on December 20th, I'll take a distribution from my IRA of 150,000. I'll withhold 100% for federal income tax purposes. Now I have this giant distribution, but I don't want to pay tax on that. I don't want to add another $150,000 of income. So I will complete a rollover within the 60-day allotment by taking the money that I have literally banked in my account and putting it back into that IRA within 60 days. So I've eliminated the 10% penalty. I've eliminated the income tax liability on that. And on top of that, I have had full use of my capital for 360, maybe 350 days out of the year, as opposed to paying in throughout the year. So it's a really neat little trick. Again, not quite as valuable today, where interest rates are not that high. So your benefit of your own money is lower, as is for everything. But it's still a cool trick, and it works just the same if you've got a client who's under withheld, right? Like I gave an example of intentionally doing that, but you could find somebody right now who's got $20,000 that they've under withheld. If they've got a retirement account, they can have access to it. You can take a distribution, withhold 100%, and if it's an IRA, provided they haven't had another rollover within the past 365 days, you're good. Just take it from their bank account, their brokerage account, and put it back into the IRA within 60 days, and done. Problem solved.
Yeah, I've totally done that. I think it was an emergency situation when I did it, rather than a, planned ahead event, but it's good to know. And I think this is back when 60-day rollovers were easier to do and you didn't have that 1 year limitation.
Yeah. So we've had the 1 year limitation pretty much forever, but it was probably before the Bob Rao ruling, which I think was 2014 when that, it was 2014 when that happened, and 2015 where the rule change was effective, where effectively it's not that we went to the 1 year rule, but it changed it from being, if you've got 10 accounts, you can do one 60-day rollover from each of them, to if you have IRAs, everything is looked at as one giant account, and we're going. And the crazy part about this, I know I'm going off on a tangent here, but I can't help myself. The IRS had that wrong in their own publication. They went to court. Bob Rao went to court. They met in court. Neither one of them argued this whole, hey, we should have this on an aggregate basis. And the court was kind of like, by the way, I think you've got this wrong, and it's on an aggregate basis. And we ended up with this interpretation. So yeah,
okay.
really, really interesting. And that, by the way, gave that court case gave rise to my favorite line when I'm talking about why advisors, or clients, I should say, need a good tax advisor or tax planner, right? Financial advisor who knows taxes, or CPA who does planning, et cetera. The quote from the court case is, and I think I'm going to get this word for word, but it's not, it's pretty darn close. Taxpayers rely on the guidance of IRS at their own peril. That is, like, Bob Rao was like, wait, look, it says this in the publication. How? And the court said, no, you rely on that guidance at your own peril. So that is why you can't even rely on the IRS for some.
It's not good. Yeah, that's not good. Well, okay, so just to summarize that strategy, which I think is important for people to hear, like what you would do is, if you're in a jam, or if you want to preserve cash for whatever reason, skipping a year's worth of estimated tax payments, just hold it, wait. And at the end of the year, and you're right, don't do it on December 31. Do it like mid-December. Give your advisor some time off on Christmas so they're not scrambling. But you can do a distribution with 100% withheld.
Yep.
And to prevent that distribution from becoming a taxable event in its own right, you put the money back in within 60 days, making it a 60-day rollover. The IRA is back to where it was value-wise, so that's great. You didn't take money out of the IRA. You covered the tax bill, but you did burn a 60-day rollover, so you can't do that strategy again until 365 days after that.
Yeah, I generally like that more for the fixes, but I love your first example, if you will, for kind of annual planning. If I have a retiree who has to take an RMD
that they don't need, if they don't really even need the cash from it, yeah,
like using that to satisfy any sort of tax liability is fantastic, because we can wait until the end of the year. And now the only caveat I'll point out there is, you also do need to realize that you have to satisfy any RMD before you take additional distributions. So the rub there for some clients is, well, yeah, I want to take my RMD, but I want to convert above that. There, you can't really use this strategy unless you want to withhold early in the year, right? But that kind of defeats the idea of waiting until late in the year and benefiting from that, because you can't convert until you've taken that RMD from the account.
Yeah, what we did frequently, and again, I think my client base was maybe folks who had, as a percentage of assets, maybe more retirement than most folks. We would tell them, like, don't even worry about estimated tax. Let's just come together at the end of the year and either hit the safe harbor amount, or let's do an estimate and kind of figure out what a good safe amount to do at the end of the year is. And that worked really well for them. They didn't have to worry about estimated taxes.
Yep. And
they would always ask, like, don't I need to pay this throughout the year? And we're like, no, because withholding from a retirement account,
people love it.
Yeah. They love not worrying about the estimated taxes. And they love the fact that they're not doing anything wrong, so to speak, because that's the way the rule works. It's considered as if it happened throughout the year. All right, so we covered that. We covered estimated tax. You got to, if you got to do it. You can't wait until April 15th. You got to pay throughout the year. There are ways to get around that through either withholding from your paycheck, so upping your withholding at the end of the year, or doing this method, the two methods we talked about, pulling out of retirement accounts. Any other end of year things people should be mindful of, or did we cover all the big ones?
I mean, for with respect to end of year planning, we could go on for another hour or two, Roger, if you want. But I mean, from an estimated tax perspective, I think that largely covers it. The one other point I would mention there, as you were saying, I just want to hit on that withholdings have to be done by end of year, right? This is not something where you can do it in the following year, like up to April 15th for previous year, or whereas you can make estimated tax payments for Q4 until January 15th. Withholdings are done and they're treated as withheld in the year that you do them.
Yep.
So if this is again why we're saying don't wait till December 31st. Mid-December is probably a very fair time to kind of put a deadline on that.
And really, when it comes to running numbers for clients, we're recording this on October 18th. Somehow it's mid-October. I don't know how
I
that
get
happened.
there. Yeah.
I don't know, but really, the time is now to run numbers for clients to figure out, we have a better picture of what's happening throughout the year income wise. We know what they've done withholding wise throughout the year. Like, now is the time to make a course adjustment. Do not wait until early December, because that's going to be, you'll lose the ability to do some of these things like the paycheck withholding, that sort of thing. That will be gone for you. So anyway, who would have thought that we could talk for 15, 20 minutes about withholding, but
That's a good time.
there's a lot there. So Jeff, with that, thank you. I think we covered some good stuff for people, and time's a wasting for folks who want to get on this, because like we said, it's mid-October. So get
Have
on it,
at
run some projections.
it. Yeah.
Great. Well, we'll be back with more end of year things. There's plenty more stuff on our list to talk about that needs to happen before December 31st. So we'll be back with more. But in the meantime, Jeff, thank you so much. It's been great talking with you.
Good as always to be with you.